Today, U.S. lawmakers urge the SEC to approve spot Bitcoin ETFs. Bankrupt crypto lender BlockFi inches closer to repaying customers. And Jennifer Schulp of the Cato Institute, who testified before lawmakers following the collapse of FTX, weighs in on crypto regulation in the U.S. Welcome to CNBC's Crypto World. I'm Mackenzie Sigalos. Digital currencies bouncing back a bit from yesterday's losses. By noon Eastern, Bitcoin traded just below $26,300. Ether rose to $1,600, while Solana dipped to $1,893. Okay, let's talk about the top stories. A bipartisan group of lawmakers are urging the SEC to approve spot Bitcoin ETFs. The letter, addressed to Chair Gensler, was penned by House Republicans Tom Emmer and Mike Flood, along with Democratic members Wiley Nickel and Richie Torres. Now, in it, the congressman urged the SEC, quote, not to continue to discriminate against spot Bitcoin exchange-traded products after a federal court ruled the proposed funds were materially similar to futures ETFs already approved by the agency. That letter was sent to Gensler yesterday, ahead of his testimony before the House Financial Services Committee this morning, where Gensler made it clear that he wouldn't be talking about ongoing litigation surrounding the ETFs. Now, at the same time, the SEC just delayed a decision on a spot Bitcoin ETF proposed by ARK and 21 Shares until next year, and there's growing concern that delays could worsen if Congress fails to reach a deal to fund the government and avoid a shutdown. Next, bankrupt crypto lender BlockFi just scored court approval to restructure. Now, the plan, approved on Tuesday, will let the company liquidate its assets and repay customers, but the amount it will actually return to those customers will largely depend on a legal battle with similarly bankrupt FTX and Three Arrows Capital. Those companies claim they're entitled to $5 billion from BlockFi, and BlockFi argues that would ultimately harm its customers, who it says are the real victims of FTX's fraud. Last, Mixin, the Hong Kong-based crypto protocol hit by a $200 million hack last weekend, wants to make a deal with its attackers. According to Etherscan, Mixin sent a message to the hackers offering to let them keep $20 million if they returned the rest of the funds. Mixin said that most of its assets were users and asked the hackers to refund them. Now, according to Mixin, hackers were able to use an exploit from a third-party cloud provider to access those funds. All right, for our main story, a few weeks after the collapse of FTX, Jennifer Schulp, the Cato Institute's Director of Financial Regulation Studies, testified before lawmakers on that bankruptcy. During her testimony, she argued that clear regulation needed to be a priority for policymakers. So Crypto World's Talia Kaplan caught up with her to get her thoughts on the regulatory advancements here in the U.S. since that hearing.
About a month after FTX filed for bankruptcy, you testified before lawmakers during a hearing called Crypto Crash: Why the FTX Bubble Burst and the Harm to Consumers. During your testimony, you argued that there are three takeaways for policymakers from the FTX collapse, including that unclear regulation remains a problem that can drive innovation offshore. So it has been about 9 months since that hearing, and we have seen some regulatory developments here in the U.S. since then. For example, in July, U.S. lawmakers advanced Fit for the 21st Century Act to establish a crypto framework. But is that development and others enough to prevent driving innovation overseas?
I don't think that we're at a point yet where we can say enough has been done. While that act and the other legislation that's been passed out of committee in the House on stablecoin regulation are a good start, they're nothing more than legislation at this point, and it's not even a bill, a proposed piece of legislation that's been passed by the full House of Representatives. So we're kind of in the stage of still thinking about and proposing ideas to bring that regulatory clarity to bear. We have not hit the point where regulatory clarity is really even something that's very obviously coming in the near term.
So expanding on that, in July, you touched on this, the U.S. House Financial Services Committee advanced the bill to establish a federal regulatory framework for stablecoins. What do you make of that long-awaited stablecoin bill, and what do you think will happen with that?
I think it still remains to be seen what's going to happen with that. There was some bipartisan support coming out of the House Financial Services Committee, but there have been objections to that bill coming from the Biden administration. And that's a major hurdle that the bill will have to pass in order to get through the Senate, assuming that it even passes the House. Given Republican control in the House and the already some burgeoning bipartisan support, passing the House is possibly going to happen. But the Senate is a much different hurdle, and the Biden administration's objections here will carry a lot of weight in the democratically controlled Senate. And while the bill seems to have some momentum, it's far from a done deal at this point.
You also discussed stablecoins during that hearing back in December, saying that you believe they have a lot of promise. You said there are obvious risks associated with stablecoins, but that there are obvious ways to deal with those risks. Can you expand on that?
Sure. I think stablecoins have, as I said, obvious risks. The biggest risk being that they're not backed by the assets that they say they're backed by, and that the stablecoins themselves are not being, let's say, properly represented to the public about their backing. It's a pretty easy solution to that, which is to require disclosure about the reserves that back stablecoins, as well as kind of limit those reserves to the types of assets that we truly believe are stable. You can see that that type of framework has been put into place in some of the pending legislation on the topic, although a lot of that legislation goes much further, including sorts of regulatory authority for the banking regulators to examine and require the stablecoin issuers to meet more bank-like regulation. I don't think that's completely necessary, but having basic protections in place that make sure that stablecoins are backed by what they said they're being backed by is really the most important risk to be addressed here.
Is it too late for the US to catch up to the rest of the world as it pertains to regulation? In April, EU lawmakers approved the world's first comprehensive framework for crypto regulation. We have seen advancements in other parts of the world, including the UK and Hong Kong. And amid the regulatory advancements abroad, several crypto firms here in the US have shared plans to expand overseas. That includes the publicly traded crypto firms Coinbase and Bakkt. What do you make of that push from US crypto companies to expand into international markets? And do you expect to see more of that happening amid the lack of regulatory clarity here in the US and advancements abroad?
Look, to start, I hope it's not too late for the US to catch up. But the longer the US waits on this front, the more danger there is in companies leaving our shores. But I think in many ways, more importantly, companies never coming to our shores to begin with. Companies that are just starting now and making a decision about where they'd like to headquarter, which customers they'd like to serve, find it much easier to do so when they're looking at regulatory regimes that provide clear answers. And the US simply does not do that at this point. So while we might be a little bit slower to have some of the companies that are here leave, like the Coinbases of the world, those new companies that are starting are much less likely to want to be in the US and serve US consumers.
During your testimony in December, you also noted that you wanted lawmakers to clearly define if cryptocurrencies fall under the purview of the SEC or CFTC. You argued that you think some cryptocurrencies do fall under the category of security. Why do you feel that way, and which ones?
Well, the which ones is difficult to say because there's a lot of different types of crypto out there, and I don't want to do the SEC chair dance saying that you couldn't ever figure out which one is a security and which one is a commodity. But there's a pretty clear dividing line in my worldview between what the securities laws are meant to do and what the CFTC is meant to do in its regulation. And the securities laws are aimed at preventing abuse and fraud by individuals who are in the middle of a securities transaction. So when you think about a company, it's the managers of the company that know more about how a company operates than the investors in that company. And there are plenty of crypto tokens that are in that circumstance where the project's owners, the project's managers, the project's developers are trying to get investors on board. And those developers, managers, entrepreneurs know so much more about that product than the people at the end of the day that are investing in it. And the people that are running the product are making promises about where the investment is going to go. Is it going to grow based on their efforts? That's the securities law's purpose. And where a crypto token is functioning that way, it should fall under the securities laws. That said, some parts of the securities laws don't make a lot of sense for current crypto products, and we need to revisit how some of those laws work. But as a general matter, the securities laws are appropriate in those circumstances. Commodities laws apply more fully where we have a decentralized product that looks a lot more like gold or grain, where there isn't someone who controls the product and is making promises to the end user about how the product is going to operate. I think everyone agrees that Bitcoin is in that circumstance. I think it's pretty easy to make an argument that Ether is in that place as well. And there may be other tokens that fit the bill too. But there's a pretty clear dividing line for me, and that dividing line keys off of decentralization as to whether the CFTC or the SEC should have jurisdiction.
Schulp also weighed in on the recent court rulings involving Ripple and Grayscale. You can hear her reaction to those rulings in her full interview on CNBC.com/Crypto World. Okay, that's all for today, but we will be back again tomorrow, and we'll see you then.